Folks, welcome back to the Contrarian Trader. This is Robert Desmond. It is Sunday, February the 28th, 2010. Folks, the saying goes, weather-wise anyway, that March comes in like a lion and leaves like a lamb. Economically speaking, the first part may be right, but the latter part, leaving like a lamb, may be in question. I say this because effective March 1st, 1.2 million people that are currently receiving unemployment benefits through the federal government. In other words, these are the people that have had their state unemployment benefits expire. Then they went on to the federal unemployment rolls to receive benefits, which includes their COBRA insurance benefits. That's going to end effective tomorrow. So 1.2 million people will be without checks. You don't hear that spoken about all too much. That was defeated in the Senate last week. So that's how March is going to come in like a lion for many people. Leaving like a lamb is going to be difficult due to the fact that there's not much by way that the federal government is going to be able to do to lower interest rates any more than where they are. Now, at the end of March, the Federal Reserve will have completed their $1.25 trillion purchase of mortgage-backed securities, which have helped keep interest rates as low as they are. Now, last week, the existing home sales numbers for January came out, and they were down 7.2%. Now, I have to ask myself this question. If we are in a recovery, as the talking heads on CNBC would have us believe, they want you to ignore the data that's coming out. If we're in a recovery and we have interest rates at historic lows and we have a home buyer tax credit of $8,000, which is set to expire in April, that is supposed to be helping to shore up the housing market and helping to boost sales. If we can't get people to buy now, what's going to happen at the end of March when the purchase of the mortgage-backed securities expire, and then in April when the tax credit expires? What's going to happen at that time as interest rates are rising, unemployment continues to grow? We have 18% unemployment, real unemployment, not the 9.7% that they like to talk about on TV. The real unemployment rate, which is about to spike now with 1.2 million people not receiving benefits, 18% real unemployment in this country. And it was reflected in the consumer confidence numbers last week. But the talking heads, apparently we're in a grand recovery. So the question is, where to from here? Well, the markets were able to recapture the 1100 level last week. Fairly bullish week, although it closed down. The down volume continued to trend down. It came in below average, but still outpaced the up volume that we saw the previous weeks. So, could we rally from here? Absolutely. I'll get into that further with my subscribers. But the question that I have is, what's going to be the rocket fuel with all these headwinds that are coming up on us? What's going to be the rocket fuel that pushes us through the 1150 level? I don't know. It's going to be rare that you hear somebody that considers himself to be a professional in this market to ever say, I don't know. But it would be intellectually dishonest for me or anybody else to say exactly what's going to happen anytime soon. I can use charts and say the probability favors longs or shorts. Currently, we are net short this market. Can we rally higher from here? Absolutely. Absolutely. So I don't believe that we're going to break above the 1150 level. I think we are going to fail, and I think that we are going to pull back to a minimum to retest the lows of 1175 at a minimum, this support level right here. What's it going to take to get us there? Well, if we see a jobless claims rise as predicted, it's going to happen. If we see taxes continue to rise and trade deficit rise, it's going to continue to happen. If we see home sales drop as it did back in January, you're going to see the Home Depots of the world lay off people because there's no reason to have people stocking the shelves if people aren't buying to fix up their new homes. So it's not good. What's going to lead this rally higher? Looks like the small caps may do it. The small caps, if anything, they've although they closed down last week, you saw some bottoming action here, some bottoming tails on this candlestick. Does it look like to me that we're probably going to roll over? Yeah, I think that we are. But if we are going to break out, I believe it's going to be the smaller caps. It'll probably lead us higher here. Also, you saw on the XLF some pretty decent consolidation here, although it's underperformed the S&P 500 since August. It broke above this downtrend line here last week. Some bottoming action here on the XLF. Basically a W formation, a bottom here, rally higher up to 1570, then a retest, successful retest, and it appears that we're going to get a continued rally higher. Will it break out here? I don't know. It's yet to be seen. But volume last week was not nice. It wasn't exciting. So we can go either way here. I don't know which way we're going to head. So I'll be advising my subscribers how we're going to position ourselves to take advantage of the market in either case. We're going to be focusing on stocks that are at extreme highs or extreme oversold levels, extreme overbought or extreme oversold level, because our risk to reward, it's in our favor when we trade stocks like that in this environment. If we see a breakout, we'll probably close out some of our short positions, open up a hedge with some longer ETFs. So I'll discuss that further with my members. But let's just keep in mind that we have a lot of headwinds that are on the horizon here, folks. And traders, institutional traders, they're going to act far in advance of the events occurring. That's what professionals are trained to do. It's the little guy. Here, I'll give you for instance. You had Cowan and Company last week. They came out and they issued a buy rating, so along with Raymond James. There's a tape on CNBC. I sent it out to my members last week. I sent out a short alert last week. We went short of Home Depot last week in the face of Cowan and Company and Raymond James saying, "Oh, buy Home Depot into earnings." I told my subscribers, I almost fainted at the audacity of these people to do this, to issue this upgrade. How self-serving, how low can you go? And I pointed out, here's a weekly chart of Home Depot. You have the stock trading at the upper band of its uptrend line, and you issue a buy rating? Are you mad? How dishonest can you be? Or do they just not know? Are they that inept? Let's call them inept, or also try to sue me. Any experienced chartist will tell you, listen, you sell up here. Here, the top of the band. This is where you sell. It worked back here, worked over here, worked here, worked here. It's going to work here too. My subscribers, I told them, let's get short. We're short of Home Depot. We went the opposite direction. We decided not to take the advice of Raymond James and Cowan and Company because it's worthless. So please, take advantage of our 14-day free trial offer. Don't listen to these talking heads on CNBC. Join the Contrarian Trader. Get straight up front. Speak. Don't get spoken to. Get the truth about what's going on out there. This is the truth. You don't buy here, you short here. If you have any questions, please, folks, shoot me an email at the Contrarian Trader. If nothing else, sign up for my YouTube channel. Please subscribe. I'd love to get that number up higher. That's my goal. And I'll speak to you soon. Everybody have a great, great trading week. Be safe. And don't listen to these thugs. Take advantage of a 14-day free trial offer. Thank you, folks.